Hello, this is Martin from Secret, the channel for learning about trading and investing. Welcome to a brand new episode on the investment and trading. And today we have something very interesting, which is covered calls. This is part of a hedging and portfolio building, and with the help of options. And the previous video in this category we had seen last cash secured puts, and I hope you had enjoyed it. And if you're not seen, please right away go and look at the the cash secured put also, right? So let's get to learn what is covered call, right? So what is covered call? So basically we are doing nothing but selling a call option, right? We are doing nothing but selling a call option, which is a out of the money OTM call options. And the assumption is that you have a certain investment that is made in the capital market, in the stock market, for a certain amount, and you are selling the OTM call option of that underlying which you have. And that maps to that underlying, and then why do we need to do that? We want to buy an insurance. We want to have an income, right? At the same time when there is no trending happening. So that's what covered call is all about, right? Using the option selling to benefit during the by rental incomes during the period of holding of your investments. The assumption is that you have some investment that is already made. The strategy is with that assumption. Keep that in mind. It's not that you don't have any investment that is made on the stocks, right? There is no money that is invested, and then you want you don't do the covered calls. You do the cover to cover. To cover itself means to protect, to buy an insurance, to generate rental income, right? So that's what we are doing. We are hedging that. So let's get into the details. Oh, this is a mistake right away. This slide is a copy paste of the previous one. This is not CSP, it's covered call, right? CSP is the cash secured put that we had seen. So it gives, obviously it gives, just like CSP also, it gives a rental income, regular rental income, but primary purpose of that is to protect. It's to hedge your investment on the long-term holding, right? The primary purpose is not to invest. The covered cash secured puts, the primary purpose is to invest, right, at a lower price, at a desired price, right? And while the covered calls basically is to generate some income during the period when it is not that trending. And even if the market falls, you are buying an insurance both, right? And bottom fishing also, it can be used for bottom fishing also. So say for example, you're thinking that the market is at a very low level, and it may have formed a bottom, and then it may not further go down. But you never know markets how they react. It may further go down also. So with that very low risk, you are deploying a cash secured, deploying a covered call, and then benefiting from that rental income until the trend happens. The moment the trend happens, you just extend the covered call. So it can be used for bottom fishing also. The primary purpose is to hedge or protect your long-term investments, at the same time generate a regular rental income on your investments that's made, right? So you as in the cash secured, but you can do it in different ways, right? Covered call can be based on the Nifty index, right? The Nifty index ETFs, Nifty Bs, or Nifty futures, or it can be in the it can be the stock itself, any particular stock that is listed in the Nifty, and it can be on the futures of the stock, right? So these are different ways of doing. So you can use any of this to hedge your positions. Any of this can be used to generate rental income. Right? So the first question is how much to sell. Right? So I know that if you are selling on the opposite direction as a hedge, you will benefit if price moves in the opposite direction, right? That's what hedging is also about. But how much? How much is depending on how much you invested total, right? Divided by how much is the call option, the options contract value, right? That would be the number of lots that you have to sell. Right? So the stock, when you are selling, it would have its own lot size multiplied by the number of lots. So that number of lots would be total investment divided by. We will come to the details in the next slide. So this demonstrates the previous, how much to sell also and where to sell, right? The two questions: where to sell. When you say options, you can sell the options. It's speculative, right? You can sell it at any strikes. Which strikes you need to sell, right? And the first question was how much quantity do I need to sell? That is clear more or less. So we'll see what strike price to choose. So The general rule is that when you are selling a call, you have to sell at a price which has a premium that is equivalent to what is your desired rental income that is targeted. And 3 to 5% per month rental income is pretty much good. Even one to three, 1, 2, 3, up to 5 maximum. That depends, right? So if you're getting 3, well and good, right? Because multiplied by the number of months, you have a very good profit that is made at the end of the year, right? So, say for example, you have total investment that is made is 25 lakhs. You have 25 lakhs of capital that is invested in SBI. So SBI, one lot size is 1,500 and 520 is the price. Means roughly, you might have bought it at a different price, but whatever the price is, it approximately, for learning purpose, we can say it comes to 7.8 lakhs per lot, right? Because 520 into 1,500, right? So that 8 lakhs is for one lot, and you can buy 3 lots because you have invested 3 times that, 8 into 3, 24. So 3 lots is what is the number of lots that you have to sell, right? The question that is answered here, right? The total capital of 25 divided by the contract value of 7.5. So lot size is 1,500. So 1,500 and 3 lots. So target, suppose we plan to get a target income of 3%. Then you have to sell at a premium, right, which will generate you 3% of the total 25. That's 75,000 per month income is. So that means if you divide that amount by the lot size into the number of lots, so if you're selling a 17 rupees premium, then that would make sure that you have 3% profit per month that comes in, right? So you can sell this at the current month or next month, at the end of the year month, after 3 months, whatever you do, the target, where should I choose the strike is dependent on this, right? You should choose a strike depending on what is the expected return per month that you want to generate from the capital that you have invested. So 25 lakhs, 3% is 75,000. For that, how much premium is required? Go to that strike which has got that premium and sell it. You can be this month, next month, month after that, whatever. And every month you can roll it over. If that is a strategy, that's how you select the price. Now payoff looks, if you're selling a call options, any price movement that's downside, you will get the premium that you have collected. Whatever 23.9 is, for example, is just for demo purpose. So whatever is the premium that you collected, it will be yours as wherever the price goes in downside. But the upsides, if it does not breach this 543 in the case of this example, then you are in front. If it goes beyond that, you have a trouble. You have to book a loss, and then, but you will have benefited from the price up move that has happened in the underlying investment that you have made in the stock or the futures, right? Because when the State Bank of India moves down, then you benefit from the call options that you have sold. But State Bank of India, when it moves up, you benefit from the futures or the stocks that you have earned, but you will be losing lightly on this call that you have sold. So we would look at when you have to exit, right? That is the obvious question that will come now. How long you have to keep hold? So there are 3 scenarios. One is, we'll look at that next slide. So before that, what to sell? Right? Which stocks to sell? Can you sell any stock? Can you sell X Bank? No, obviously not. You would be selling those which are in the Nifty 50 and also which are there in the Nifty 50 futures. Now the assumption is that they would be primarily large caps and they would have some liquidity, right? You should not get stuck with liquidity when you're trying to exit. So that's a primary goal. So only go for liquid Nifty 50 stocks only for the covered calls. Now different methods are used for doing the cover calls. I'm just briefly touching upon each of those. So which one has to be applied? It is up to you to decide. Right? Now one way is to look at the selling the call options based on purely on the charts. Now you would look at the chart of a stock and you would see that for example, you can say the moving average is breached. Certain moving average is 50 or 100 or depending on what is the time horizon. Say if you're looking for monthly, always 100 EMA would be somewhere appropriate. So keep selling the call. If there is a breach, that means the price is moving down. That means the moves. So the price. So there is a breach of the, and also a lower pattern whenever it is formed. So that means yeah. So that's one example of so basically selling on the charts based on the technical technical indicators, or like moving average, price action, pivots, or so based on that you sell. So whenever that breach happens, you sell it. Right? That is one way of it. Another is to blindly sell, take a risk of 10% upside or down, upside basically. Right? So you say you have 500 as your cost, 10% of that you would sell at that strike, right? But you would need a premium for that, so you do it several days before, like where the premium would be there. So months, at least 1 month, 1.5 months before, if you sell, then you'll have enough premium. Excuse me. So yeah, so income, another method is to sell strike which require premiums as per the calculation that we've already seen, right? You sell it, instead of just 10% and whatever premium is there, you sell, and then instead of that, you have a desired targeted income and what is the required premium, and that strike which has got the premium, you sell it. That is one way. Then there is way of selling this month, and then you can sell instead of just selling the current month or the next month's. For example, at the beginning of the month, you sell the strike. So along with that, if you buy a in the money option of the next month, you will get the time decay benefit, right? So probability of success in this strategy can be increased that way. So there are different alterations of the same thing. Instead of going every month, selling it, rolling it, or squaring off it, then taking another push. Instead of that, you can do a total hedging on the beginning of the year with the December month's strike that is selected, right? So you get enough good premium also. Right? There is no need of rolling over across. So that is also if you're going for long-term options in this month. So these are different ways that you can do. Now, what about adjustments? So adjustment is a possibility that the price can move up, right? So there are different scenarios. So one is that the price. So what are we assuming, right? We are assuming that the price would not breach certain level. So if the price breaches the upside, then you have a problem. You lose the whatever you have sold, whatever the premium is there, you lose that money, right? So you book so what you can do is you score off that position, take the loss, and then sell the upcoming next month. If there is a breach on the upside. Similarly, downside, if you are the price is moving below, it's fine. You already got the benefit, but it is going further down, right? So then you are keep incurring the loss. So one way would be to book the profit, whatever you have got already from the selling of the call, and then invest in that stock whenever it reaches a support level, because you have to understand that the quality stocks is all that we will buy ever, right? Fundamentally this is an investment strategy, right? We are just making the options to benefit from the hedging. One other strategy is the Wheeler strategy, right? So that is where the adjustment is like this, like you get to a loss. That means the price moves beyond your point and beyond your point upside, and then you lost the money, but then you reverse and then take sell the put. So that is where cash secured put and covered call both are interchangeably used. That's what the Wheeler strategy is all about. That's one way of doing it. Second is first one we are already seen. Second Wheeler we have seen. Then another way is using a martingale system. That's where you square off wherever you got loss, when it is 2 or 3 times, when it is double of what price premium that you had set at the strike. If it doubles that, then sell double of that, right, for the next month. So that is known as martingale strategy. So there are all different ways of adjustments, right? So 3 different ways are mentioned here. I hope you can look forward further on these three different adjustment methods, and then you'll understand. So that's a summary of what I have for the cash covered calls. I hope it's pretty much clear, and if that helps you in any way, to understand what covered call is all about, how it helps the investment, how it helps you to protect your investment, at the same time how it benefits you to get a regular rental income, right? And if you understood that, and then if that you learned something from this, share it to your friends and colleagues, and happy learning, happy trading.